If I had $800,000 to deploy into a Melbourne investment property, I already know the three suburbs I'd be looking at. Not 10, not 20, three. Because the PropSpotter filter, the one we run for our client briefs, leaves only three standing across the entire Melbourne Metro. In the next 12 minutes, I'll show you all three: the supply dynamics, the vacancy rates, the growth profiles, and why these specific three are where the compounding is set up to happen over the next 5 to 10 years. Before we dive in, if you're new to the channel, I'm Sean and I run PropSpotter. We've built a property investment framework built on three pillars: research, source, and coach. What that means in practice is this: we use over 30 institutional grade data sources to identify the right suburbs for your strategy. Then our proprietary listing system monitors those suburbs 24/7 and alerts you the moment a new property goes live, before most investors have even opened domain or real estate that morning. And then our team coaches you through every step from evaluation to settlement via a dedicated WhatsApp group. It's everything a buyer's agent provides: the research, the sourcing, the guidance, except you keep the skills, you stay in control of every decision, and it costs a fraction of the price. We've coached over 50 investors across Australia with a perfect 5-star rating on Google. If you want to learn more, the link to book a free strategy call is in the description. Now, let's get into the data. Let me walk you through the filter, because the filter is the work. Once it's calibrated properly, the suburbs surface themselves. There are 4 criteria I weight the most heavily, and 3 of them are leading indicators. That matters because leading indicators tell you what's likely to happen. Trailing indicators just tell you what did. Filter 1, the price ceiling. Typical house price under $900,000. This is the realistic middle ring Melbourne entry point for a serviceable investor budget. Below this, you're generally buying out of Melbourne or regional. Above it, yield gets too difficult to service on current lending rates. Filter 2, vacancy rate under 1.5%. This is the leading rental growth indicator. When rental vacancy is below 1.5%, landlords have the pricing power. Rent growth comes throughout without arguing with tenants. When vacancy climbs above 2.5%, rent growth stalls and cash flow assumptions stop working. Filter 3, building approvals ratio under 1%. This is the leading capital growth indicator. It tells you how much new stock is being added to the suburb each year as a percentage of existing stock. Under 1% means your asset is scarce, constrained, commodity. Approaching 3% means developers are flooding the suburb and your property is being diluted. Filter 4, a hold period over 10 years. How long does the average owner keep their house in this suburb? Long hold periods means local residents settle in and don't leave, which structurally limits turnover stock and adds to the scarcity dynamic. Applied to every Melbourne Metro suburb in the H-tag dataset, this filter produces exactly 3 suburbs that also have strong enough growth signals to make the investment thesis work. Let's go through them. Number 3, Sunshine North, postcode 3020. It's in the Brimbank LGA, inner West Melbourne, about 12 kilometers from the CBD. Typical house price $875,000, rent of $513 a week, with a gross yield of just over 3%. The supply side is where this suburb earns its spot. 6-month average vacancy 1.29%. Building approval ratio 0.59%. That's 22 building approvals across a suburb of 7,000 dwellings. The hold period is 11.4 years. That combination, tight vacancy, minimal new supply, owners settled in long term, tells you the market is structurally supply constrained. Developers have limited land to build on, residents are staying put, rental supply stays tight, and the cycle is moving. The 1-year price growth is 9.46, more than double the 10-year annualized average of 4.46%. When the 1-year materially exceeds the long-run trend like that, it's telling you demand pressure is building against supply constraint. Why this suburb sits where it does in price terms? Sunshine North has historically been less gentrified than Footscray or Yarraville to the south. That's what keeps entry points in the $800,000 to $900,000 range rather than the $1.2 million of the more established inner west pocket. The 11.4-year hold period tells you local residents are entrenched. The 9.5% 1-year growth tells you the broader market is discovering the value. On an $870,000 purchase, 20% deposit of $174,000 and an 80% loan of $696,000 at 6.1% interest only, with $510 a week in rent, your pre-tax cash flow shortfall is approximately $250 a week. On a 1970s brick home with standard depreciation, that could compress roughly to $150 to $180 a week after tax for a top bracket PAYG investor, serviceable on a buy and hold with a standard household income. The trade-off. This is the stretch the budget pick. $180,000 deposit is real capital. If your borrowing capacity caps below $900,000, this moves down the list. If you have serviceability headroom, the supply-demand setup is genuinely compelling. Braybrook, postcode 3019, Maribyrnong LGA, directly adjacent to Footscray and Wets Footscray, and it has the single lowest vacancy rate of any suburb to pass my filter. 1.05% vacancy averaged over 6 months. At that level, effectively, and every rental property has a tenant. There's no spare stock. Tenants compete for available properties, not the other way around. Typical price $812,000, rent of $561 a week, and a yield of 3.6%. Here's the most interesting number on this suburb. 10-year price growth, 3.16% annualized. Modest. But the 10-year rent growth, 5.48% per annum. Rent has compounded 2.3 percentage points faster than price for a full decade. That's a rent-to-price divergence that historically resolves in one direction, a delayed capital growth catch-up. Landlords in Braybrook have been quietly accumulating rent increases for 10 years while waiting for capital values to reflect the underlying demand. Supply side supports this. Building approvals, 36 per year in a suburb of 5,273 dwellings. Building approval ratio of 1.6%, slightly above the cleanest on the list, but still in the supply-constrained band. 10-year hold period means owners don't leave. This suburb sits in what I describe as the gentrification spillover zone from Footscray, Seddon, and Yarraville. These three suburbs have moved structurally in the last 10 years. Braybrook sits directly north and west, still with a mid-range ERSAD score, still with entry points $300,000 to $400,000 below its neighbours. When gentrification diffusion patterns continue, Braybrook is the next obvious beneficiary. On an $800,000 purchase, 20% deposit of $160,000 and $500.50 a week in rent, you're looking at a pre-tax shortfall of around $180 a week, which will compress to $120 to $140 a week after tax on a standard depreciation schedule. The 3.6% yield, highest on the shortlist, materially reduces the cash flow burn compared to the other two picks. The trade-off. The 1-year growth is a quieter 4.1%, not the double-digit surge you see in Sunshine North or the next suburb we're talking about. This is the slow burn, rent-led catch-up thesis. If your horizon is 5 to 10 years, the data setup is among the cleanest you'll find in Middle Ring, Melbourne. And last but not least, number 1, Noble Park North, postcode 3174, Greater Dandenong LGA. This is the pick where every single metric on the filter aligns, that magical unicorn, and several of them are at the edge of what's possible in the Melbourne market. Typical price $881,000, rent of $540 a week, and yield of 3.2%. Supply discipline is the story. Building approval ratio 0.34%. 9 new dwelling approvals across a suburb of 3,100 houses. That is essentially zero new supply. Owner hold period, 14 years, the longest on this shortlist. Vacancy, 1.15% and trending down. 6 months ago, it was at 1.72%. Today, it's 0.75%. Now, demand side. 1-year price growth, 11.37%. 10-year annualized, 4.8%. The recent move is more than double the long-run trend against a supply base that's structurally frozen. Here's why this setup matters strategically. Noble Park North sits 5 minutes drive from Clayton, which is one of the 6 suburban rail loop East Station precincts. SRL East transforms the Melbourne Eastern Corridor by 2035, and any suburb with strong existing amenity and supply constraint that's within 5 minutes of a new SRL station is structurally positioned to absorb spillover demand for the next decade. Combine that infrastructure tailwind with a frozen supply base and tightening rental market, and you have the cleanest forward compounding setup on my shortlist. The trade-off, 84 sales a year, makes it a little bit of a smaller market. Liquidity is lower than Sunshine North or Braybrook. Property management quality matters more. Greater Dandenong LGA has a broader tenant demographic mix than Melbourne's inner east, and PM selection is where investor outcomes diverge meaningfully. Look for a manager with at least a few years of 3174 postcode experience specifically. 3 suburbs that came close but didn't quite make the top 3. Worth noting in case they fit your specific situation better. Thomastown, typical 868k, 1-year growth 11.6%, building approval ratio of 0.5%. Would have been a 4th pick, but the vacancy sits at 1.56%, just a little bit above the threshold. Still one of the strongest forward setups in Middle Ring Melbourne. Bannockburn, typical 853 with 3-bedroom entries at about 750,000. 10-year growth 8.37%, the strongest long-run track record of anything we looked at. It's a Geelong satellite, not a Melbourne Metro. If your strategy allows for a satellite city positioning, it's worth a serious look. West Footscray, building approval ratio 0.33%, the lowest new supply pipeline anywhere on the list. 2 beds are entering at about 750 grand, with all bedrooms at about 1.05 million. If you're open to a townhouse or a smaller dwelling, the supply dynamics are equally as elite. If I had to deploy $800,000 into a Melbourne Metro investment property today, the order: Noble Park first, Braybrook second, Sunshine North third. Each one sits on a structural supply constraint, meaning a tightening demand profile with a different underlying thesis. Infrastructure tailwind for Noble Park North, rent to price catch up for Braybrook, and inner west corridor acceleration for Sunshine North. The bigger principle: the filter does the work. When you build a short list from leading indicators, vacancy, supply pipeline, hold period, rather than trailing indicators like headline growth numbers, you end up with a fundamentally different set of suburbs. Usually a smaller set, usually boring names, and usually the suburbs where compounding is set up to quietly happen over the next cycle. If this was useful, drop a comment telling us which 3 you'd deploy your capital into first, and which Melbourne corridor, west, inner west, or southeast you think will outperform over the next 5 years. If you liked what you saw here, it always helps to subscribe and engage with the channel, and I'll be putting out more. So I'll see you guys in the next one.